So here we are today, June 15th, 2022 for the Think Tank Exchange with two chief investment strategists. This is so super cool. We're going to let some people in, and then I'll introduce my guests, and we'll have some real fun on this magic day where the Fed is going to make an important decision, and the markets are going to react. Thank you both for joining us in the Think Tank Exchange. I think the timing of this interview is just so apropos. So with me is Michael Arone from State Street, who is the chief investment strategist for State Street Global, and also somebody who proudly has been with the same firm for 25 years. And I admire you for that. And Fritz, Folts, well, you haven't been with this same firm for 25 years. The team has been together for a super long time as well. And you're a member of the investment committee. And while candidly, I think everybody knows who State Street is, I would like to just take a moment and give you the opportunity to tell the audience a little bit about yourself as well as your firm.
Great. Well, you're absolutely right. I'm the chief investment strategist, member of the investment committee at 3Edge Asset Management. And we were launched in January of 2016. However, as you indicated, the story of our firm really goes back to the early 2000s and our precursor firm, which was Windward Investment Management. And that was really one of the very early ETF strategist firms. And so we grew with the ETF industry. And we had Windward was started in the early 2000s. We grew that firm. We ultimately sold it to Charles Schwab. It became Windhaven Investment Management. And then after a transitionary period, the core research and investment team, we left. And obviously we couldn't, the next day get into the investment management business. We had a non-compete, but we could start to pull together our firm, which we started to do because we knew we wanted to continue to work together and do what we're doing, but we wanted to do it a smaller firm. And we launched January 1st, 2016, 3Edge Asset Management. We are still ETF strategists, global multi-asset tactical managers. So it's been a great 20 years, and Steve Cucchiaro is probably the best known of the folks, and he's our chief investment officer, and he really is the one who was a pioneer in constructing portfolios through index exchange traded funds. So it's been a great ride. It's been a lot of fun.
Yeah, I've been in the ETF industry for I think about as long as you, and yeah. I remember reading a Harvard case study about you all, and I still have that Harvard case study. I'm going to share it with you if you want to check it out, but I'm sure you remember it well.
I do.
So here we are at such a pivotal point in history where the Fed is going to take some action. So I kind of wanted to just set the table here, and we don't have necessarily the right answer, but we're strategists and we should be thinking about what the Fed action will be today. Michael, do you want to go first on guessing what the action will be? By the way, not what it should be, but what it will be.
Well, I think the Fed will raise rates by 75 basis points today. I think earlier this week, and as you mentioned, it's June 15th here. Earlier this week, I think essentially the Federal Reserve leaked that back to the Wall Street Journal. So I'd expect a 75 basis points increase in the Fed funds rate today. Certainly last week's inflation data on the CPI suggested that the Fed continues to be far behind the inflation curve, and they have some catching up to do. They signaled that to the Wall Street Journal, and they will follow through today with a 75 basis point rate hike. Now, Dan, I think the real interesting thing here will be today, not only do we get the post-meeting press conference from Chairman Powell, but we also get the summary of economic projections. And so that, I think, will be fascinating to see how those have changed from the last meeting. given the fact that the inflation data remains hot and what their expectations are for the economy as we're starting to see some of those cracks form. Retail sales data was down today, some of the mortgage data, kind of National Association of Home Builders, the kind of lowest confidence signal that we've seen in a while. So how does the Fed kind of put that all together and put that in their summary of economic projections? Do they expect inflation to remain hot? That'll be what I'll be looking for later today.
Fritz, thoughts?
Excellent. Well, I think they're kind of trapped now. I think they have to do 75. I think, Jay Powell wishes he could get away with doing 50 and pray for a softish landing. But I do think they have to do 75. And I think putting it into a little bit of context too, this idea of, and we've talked about this starting last year where we felt like our model was picking up. We're really entering this period that's going to be dramatically different for an extended period of time. So 50, 75, today, I think it will be 75, but, I think we're just in the process of going through a shift, which is going to be longer term, going from low declining interest rates, no inflation into this protracted period of rising rates, higher inflation. So it's all part of the process.
Yeah, I'm with you on all that. I think he has to do 75 and then, project out what the next step is as well, right? And be consistent with that. And Michael, we were talking before and you highlighted that the problem he's got also is, well, I think it was like 4 weeks or 6 weeks ago where he was saying, no, I wouldn't do 75. That's not even consideration. So credibility is what he's trying to build, right? And get us back on course.
Well, I've been saying for a while that this has been the most transparent Federal Reserve in history. And Chairman Powell has signaled every step of the way what he's going to do far in advance. And so, Dan, to your point, this time around, this could be the first, I don't know if I would categorize it as a misstep, but boy, this could be the first time that he has to walk this back and suggesting, as you said, just not that long ago, saying 75 is off the table. It's going to be 50 in June, 50 in July. And now I think markets will begin to question not about the Fed's credibility, but how strongly they can hold on to that forward guidance. And I think this puts that at risk a little bit. And it does seem perhaps a little panicky. So you get one CPI figure that's above expectations, and you're going to react in this way. So I think that has markets on edge in terms of the volatility and some of the moves we've seen, particularly in the fixed income market.
Fritz, you were going to say something?
No, I just, to some extent, just to give them a little bit of a break here, they have been very unlucky. They really have caught some really major bad luck, and particularly the Russia's invasion of Ukraine just, really turned the tables on everybody. But I was thinking when Michael was speaking about, do you remember all the way back to when Powell was saying that they weren't even thinking about raising rates? And yet here we are. But I think they got unlucky. I think, the shock from the Russian invasion in Ukraine and the forcing oil and food prices just so dramatically higher. They got a little bit of a bad break there.
Well,
give them a little slack.
You give them a little slack. I think they've yeah. So we'll leave it at that. The answer is 75.
They were already behind the curve.
Yes,
by then.
I think so. Yeah,
So,
I think that's
true.
So they're stepping up. So and they're stepping up in hopes of having a soft landing, right? Do you guys have an opinion on whether that's even possible at this point, or are we already in a recession? We just don't know it.
I think the odds and probabilities that we may already be in a recession or likely to enter one soon are rising pretty quickly. So I think those that hold into the hope of the softish landing camp look at the consumer, business spending, solid corporate profitability, kind of continued in terms of housing elevated. From that standpoint, again, starting to roll over some, but in terms of housing prices have been elevated. labor market tightness. And then if I look at both manufacturing and services data, would suggest that the economy is still in an expansion. The challenge with all that, Dan, is it's backward looking. And so I do think that going forward, you're already beginning to see some of the cracks in terms of the economic data, and certainly the number of companies who are now warning about their future profitability, and not solely for inflation reasons. Microsoft comes out and says the dollar strength is going to hurt our profitability. Target says we probably bought too much stuff and too much of the wrong stuff. So, and demand has shifted. So I do think that there's a number of things that are beginning to soften demand. And ultimately, the Fed has acknowledged they can't address, and Fritz was alluding to this, the supply side of the equation. The oil prices, the Russia-Ukraine conflict, China's zero COVID strategy. So if supply can't rise to meet demand, then demand has to fall. And boy, is demand starting to fall.
Yeah, I think that if they're hoping for a softish landing, then we'll probably have a recession-ish economy. But one of the things that Michael mentioned in his latest piece, which I thought was really, I grabbed onto that, was this idea of how profit margins are now very much at risk. And in many ways, driving up the markets, the equity markets in particular, as we, head into the end of last year and very early this year, it was this idea that, well, not only are these profit margins, they're very strong. Corporate earnings are very strong. And so it's okay. The equity markets, can continue higher. But if you look at, the earnings, sales were increasing, earnings were increasing, but the price of the equities was, 6x more than that. And it just wasn't sustainable. And I think that's an area that's going to be very problematic going forward, that these profit margins are going to come down. I think we're seeing that.
Well, and I'm going to put in the chat your piece, Michael, because it really was good.
It was very good. It was excellent.
So let's talk about the margins, right, for a second, because we were at very high margins. I mean, isn't that, wasn't that something that people should be expecting? And similarly, I think the best case scenario is a recession at this point, and that's a heck of a lot better than dealing with stagflation or inflation, for that matter.
Yeah.
So as it relates to the margins, it's interesting. I've been a little bit more optimistic here than perhaps the market sentiment is, but I think that's beginning to shift. So if we look in aggregate across the market, and that's skewed a little bit, especially for the big technology companies, these are market weighted figures, for example. So net profit margins for the S&P 500 companies, pre-Trump tax cuts in 2017, were hovering around 10%. Today, they're north of 12%. I think the challenge is, again, that a year ago, they were closer to 13%, and they were at all-time high levels. So to Fritz's point, those profit margins have begun to decline. And I think they'll likely continue to be under pressure. So they still remain healthy, but I do think that they continue to decelerate. One of the interesting things for all those listening from an investment perspective, and this is something that we encourage investors to consider right now, is that companies that are under considerable margin pressure have suffered this year. They've underperformed. And those that have been able to expand their margins have outperformed. And given our expectations that margins will continue to decelerate, we think that's a trend that will continue. So think about companies, sectors, industries with kind of low labor intensity that can pass on higher prices or benefit from higher prices to their businesses, to their consumers. We still think those are going to be the relative winners going forward, versus companies that are going to have rising labor costs, rising input costs, and margin compression.
So in your piece, you highlighted that 70% of the S&P have issued negative guidance so far, right? Have you detected different sectors of the market that have been particularly soft?
Well, it's certainly areas in the manufacturing sector, as input prices have climbed, those remain under pressure. Consumer staples, similarly, where margins are already razor thin and now input costs are rising. So again, their only choices are to try to pass on these higher costs through price increases. And that's showing up in the inflation data, particularly on food, for example. And so we still think that staples, where, as I said, margins are pretty thin and input costs are rising, they're going to have to raise prices pretty aggressively. That's going to feed into those inflation dynamics. And then some portions of the industrial sector where manufacturing inputs are rising pretty significantly. Oil costs certainly rising from that perspective. Dollar strength, many of these are large multinational companies with global sales. Those are all likely to kind of hurt in industrials and staples in particular.
Well, listen, nobody wants a recession. It doesn't feel good, but isn't this kind of part of a self-correcting mechanism? When you've got unemployment at 3.6%, that creates part of the problem with inflation. So a little dip, I don't know if I want to see unemployment at 6%, don't get me wrong, but if we go into a recession and it's shallow, that would be awesome, right? Also might be too strong, I guess.
Well, no, I think, no, I think that's right. I mean, but I think that would also fall under Powell's expanded definition of soft-ish, right? If you say, okay, we'll have this recession, or we'll be close to it, it'll solve a lot of our problems. The problem is when these things start to happen, which are driving you into a recession or into a stagflationary environment, you also run the risk of these more extreme accidents, right? And do you get into a situation where, all the low credit quality companies now, can they refinance at higher rates? Yeah. Is there going to be an accident somewhere in the credit markets? Is going to be an accident ex-US? So I agree that would be what you just laid out would actually be, a positive, or, that would be, we would take that, right? If someone said, will you take this? We would say, yes, we would take that. The problem is when you start down that road, are there accidents along the way that make things dramatically worse? That would be what I think about that.
And Dan, I'm smiling because I've been kind of not a very popular strategist for a few years now, because I've been arguing that a recession, a normal recession, is in fact healthy for the overall economy. So not a very kind of favorable opinion here. And so my concern is, and Fritz is kind of alluding to this, is that my view is that if in fact the Fed has manipulated short-term interest rates really since the global financial crisis, they've essentially kept them artificially low. And that has benefited holders of financial assets. Let's face it, everything is up. Stocks, bonds, currencies, commodities, private equity, private credit, NFTs, SPACs, cryptocurrencies, you name it. My view is that by preventing the natural occurrence of a recession in the economic cycle, and this is what Fritz is talking about, the risks are not stable, they're building. And the potential for an accident and something that's a bit more atypical recession, meaning a further kind of drawdown or either a longer length, I think has grown. And that I think is the concern. Now, again, I'm not saying that's my forecast. It's just my concern that by preventing the natural occurrence of a recession for more than a decade has really raised the risks. And now that we're finally going to get a kind of a real interest rate or a higher hurdle rate, I am concerned that, that classic Buffett adage, and that's what Fritz is talking about, the tide's going to go out and we're going to find out who's got the swimming trunks on. And I think there might be a few folks, as that clearing mechanism happens, which is healthy, the marginal players get removed, the more speculative players get impacted. That could have some potential further risks that we're not seeing.
Michael, I was just about to pull that quote out of my hat about Buffett.
Feature of the punch.
That is perfect for where we are right now. That's the real risk.
Right. So the tide's going out, and there's likely a few folks that are swimming in their kind of birthday suits, and their swimming trunks aren't there anymore.
Yep.
We're going to find out soon enough who they might be, particularly if the Fed is going to be more aggressive. if in fact 75 today, 75 in July, we'll find out sooner rather than later, who has those swimming trunks on or not.
Now, I put your report, Michael, in the chat, and one of the comments that you made was that short-term interest rates have to rise above inflation. If I'm misquoting you, correct me. But if I am quoting you correctly, could you explain a little bit what you mean by that?
Right. So in order to stabilize inflation, the only tool that the Fed has to do it, basically, is to raise rates. And in order to stabilize inflation, you have to raise those rates above the rate of inflation. And so here in our report, and thank you both, you're very flattering in terms of your praise for it. What's interesting here, right, is that we were writing this back in May when 2-year Treasury yields were around 2.6%. And we're saying to ourselves, okay, even if we use the Fed's preferred measure of inflation, the personal consumption expenditures index, X food and energy, because hey, who needs food and energy, right? That's at 5%, a little north of 5%. Well, the target Fed funds rate is at 0.75% to 1% today. So our view was, boy, the Fed has a lot more work to do, more than the market's anticipating, and rates have to rise in order to reflect that. And sure enough, again, we get a lot of things wrong. This is one of those things that we got right. And basically now the market, just a week ago, was suggesting that the terminal rate was probably 1%, less than 1% for the Fed. And now it's near 4%. And I think that reflects this idea that in order to do what you say you're going to do, which is to stabilize prices and combat inflation, you're going to have to raise rates a lot more to do that, unless inflation starts coming down. And there again, the CPI number suggested it's been a lot more stubborn than the Fed, maybe anybody else anticipated.
So when you're talking about short-term rates, what short-term rate are you talking about getting to above inflation? Because 8.6% is not what you're talking about, I hope.
Right. No, it's not. And that's kind of the friction, right? The Fed is not going to raise rates that aggressively. So, and ultimately, our view is what we put in the report is historically the Fed's policy rate has the 2-year Treasury yield trades at about a 35 basis point premium relative to the Fed policy rate. So at the time, as we were saying, we're about 2.6%. Expectations then for the Fed's ending kind of terminal rate was around 2.8. That was consensus. You add on 35 basis points to that, and you're north of 3%. And we were at 260 at the time. So we were saying, hey, rates got to rise. So here again, Dan, if now the folks are saying the terminal rate is closer to 4%, boy, you're talking about, again, the 2-year Treasury yield could be trading, kind of around those levels, give or take 25, 30 basis points, or 0.25 to 0.3%.
I do think this brings up also the idea that, in our business, so much of what is important is not necessarily the absolute number, but the trend, the change, the velocity of that change. And that, if the Fed can convince the market that they're doing their best, they're being tough on inflation, they can hope that they can push the Fed funds rate up. They'll get this, their indicator for inflation to come down, and the two will meet, and we'll be okay. And I think that's really what you need to see. You need to see some print at some point that inflation is, less problematic and not getting worse. And if you can combine that with people being able to say, okay, the Fed has been very clear that they're going to, they're committed to doing this, then I think you'll be okay there. I think the thing to watch is the change and the rate of change of inflation and the funds rate in the 2-year. Do they have a chance to converge, if you will?
And I think markets or investors are kind of trying to gain some comfort, some clarity here. So I think a few weeks ago, there was this hopeful optimism that rates and inflation had peaked. And you saw it. Some Fed officials even suggested, hey, by September, we might be okay. And that was the week that the market rallied by more than 6%. now it's clear. And so I was concerned, and we were concerned, that that narrative was taking on a life of its own. And again, we weren't dogmatic that, hey, they hadn't peaked, but boy, underlying prices for energy and food and other things suggest, and the tightness in the labor market still suggested to us that the risks were that they hadn't peaked. And sure enough, the subsequent data suggests they haven't. And now rates are reflecting kind of a higher kind of more rate hikes and higher inflation for longer.
So we've been talking a lot about rates. Now the question becomes, what to do about them, right? Let's focus first on fixed income, and then we'll transition over to equities and how somebody should be managing to these changed conditions, right? Whether it's duration or quality of your fixed income portfolio. Fritz, do you want to go first with that?
Sure.
We'll
because
circle back to Michael.
Sure. So, we are using index ETF vehicles, right? So we want exposure in these broad asset classes. And so when our approach to fixed income really over the last going on, 12 months here is really, we wanted not to take duration risk. And so we came, we have both strategic and tactical components to the portfolio. Our strategic holding in fixed income is the 7 to 10 year US Treasury. And even if we hate the Treasury, even if we want to be as short duration as possibly can, we're still going to hold that because we could be wrong, right? We could be wrong. Something could happen in the market, and you're going to want to hold that instrument as a shock absorber. But for months and months, we have avoided corporate credit. It makes us nervous. Our model indicating that there's a lot of risk there. There's a huge amount of borrowing that's taken place. If there's an accident, that's just going to be problematic. And so we've probably given up some amount of return by just choosing to stay out of the corporate credit, either investment grade or high yield for now. And in the fixed income world, we'll hold that 7 to 10 year Treasury at its minimum for strategic. And then we invest in short-term tips, because those you will benefit from the inflationary pressure, and also in floating rate US Treasuries, really short duration floating rate US Treasuries, which I think are like 90-day bills, but they're floaters. So we're playing it very conservative on the fixed income side.
So so our kind of recommendation in our outlook was to limit duration in the pursuit of real income. So what does that mean? So there's certainly an element of being conservative here. So we continue to recognize that the fixed income portion of an investor's portfolio continues to be their biggest challenge. So yields have risen, but not enough to compensate investors above the rate of inflation. So real yields are still negative across most core fixed income. Now you have the threat of rising rates and continued elevation in inflation, and those present downside risks to the fixed income market. So what do you kind of do about it? So again, Dan, you mentioned there's lots and lots of people, lots of different folks listening. Duration is just a bond sensitivity to changes in interest rates. The longer the maturity, the more sensitive it is. So if it's 30 years, it's got a high duration and a high sensitivity to changes in interest rates. If it's lower maturity and shorter duration, it's got less sensitivity. So given our expectation for the fact that we anticipated the Fed would have to be more aggressive than originally thought, we want to be shorter duration. And I think that's kind of somewhat consistent with some of what Fritz had said, shorter duration treasuries. The other thing is that floating rate will do better than fixed rate in a rising rate environment, generally speaking, all else equal. So we also preferred floating rate relative to fixed, given our expectation around rising rates. So one of the things that we kind of like here is short duration, floating rate, investment grade corporate bonds. So high quality, kind of like Fritz was emphasizing. And from that standpoint, when the Fed started to raise rates in 2015 to 2018, the Fed funds rate went from 25 basis points to 250, or 0.25 to 2.5. At that time, yields on floating rate, short duration investment grade bonds went from about 0.9% to 3.6%. They have regular resets to reflect the higher yields. And because of those regular resets, their duration, their maturity rate now is near zero, is quite low. And so again, we think that these are some of the attributes you should consider in a portfolio. Now, the last quick thing, and I apologize, a little long-winded on this one, but man, fixed income is a real quagmire right now. So because of the inflation dynamics, as I mentioned, real yields are hard to come by. And we know investors need income.
Yep.
And so we do have to take on some risk on the credit side in order to capture real yields above the rate of inflation. So we have been recommending loans, for example, relative to fixed rate junk bonds. So now again, these are below investment grade, so it's not for the faint of heart. And as Fritz was alluding to, if credit spreads widen, there's some default rate pickup, these would be harmed. But our view is that you move up the capital structure, you get access to floating rate, you have a shorter duration profile, and your yield is commensurate with fixed rate junk bonds. So it's a way to capture some much needed income in the portfolio while managing some of those risks. But again, for those listening, it is below investment grade. So it isn't for the faint of heart in terms of that credit risk profile.
Can I just say one more thing about fixed income investing? And again, the way that we invest at 3Edge as a multi-asset investor, our conservative portfolio, which is, you could consider it to be a substitute or a complement to fixed income, the way we've approached that is to actually go out beyond fixed income assets and to look. And so if you dial back your fixed income, but the model is telling us that real assets could do well in here, commodities or gold, we would put some of those into the portfolio. We might even have some equity securities in that portfolio to come up on a total return basis anyway, with a strategy that can at least complement, a fixed income portfolio. So I do think advisors also need to think about, as they're constructing these portfolios, you may need to go beyond fixed income to satisfy those requirements that clients have.
I think it's a great point. And I think, for us, where we have tactical discretion on behalf of our institutional clients, we are underweight fixed income, given some of the dynamics that we're talking to compared to our strategic benchmark, and have chosen to take that capital and allocate it to other things like gold and commodities, for example, because we just think that they have a better kind of risk return profile in today's market. The last quick thing I want to say on fixed income is a number of weeks ago, I had several clients start to ask me about adding duration, lengthening maturities in their fixed income portfolio. So that was around the time that US 10-year treasuries broke through 3%. And they have, so they haven't been at 3.5% in more than 11 years. It's crazy. It's amazing. And so they broke through 3%, and clients started to do some bargain shopping in fixed income because fixed income assets were down so much. What I had said to them at the time, and I'd stick to this, is that it seems more of a tactical decision than a strategic one. And I felt like the risks getting this decision wrong were skewed to the downside. And that made me a little nervous. I also mentioned earlier how we had felt like with the Fed funds rate where it was and where inflation was, that boy, the Fed had to do a whole lot in terms of to catch up. And that concerned me about adding duration at this point. And then finally, what I did say to them is, what we have found is that most client portfolios, most investors are short duration. And because of fear for rising rates, because rates have been so low for so long. So what I did say to them is, if you wanted to pursue this and your duration profile is kind of at the low end of your kind of duration benchmark, kind of relative to your strategic benchmark, you could begin to nibble at some intermediate kind of investment grade corporate bonds and others to add here to pick up some yield that's improved. So those were kind of my comments. So again, now rates are even higher. And so I think, again, investors will be asking, hey, should I be adding duration at 10 years at 3.5? They haven't been here more than 11 years. Should I be buying bonds? And I would still say that those comments hold true. I'd be cautiously doing it to pick up some yield enhancement, but I think the risks are skewed to the downside.
You bring up a really important point that I think honestly has baffled a lot of people of late, meaning that the 20-year bond, right, for a lot of folks has been a place for protection in the past. And well, that isn't working right now. I mean, that's more than evident. And that's to your point. I want to twist it around a little bit along those same lines. We've been skeptical about the traditional 60-40 model for a while at Toroso. I think both of you have views around that as well, and maybe you agree, well, maybe you don't. Let's talk a little bit about that. And maybe Fritz, you go first on that, because I think you've got
Sure.
a strong opinion on it.
Well, yeah. So obviously 64 year to date, 60-40 has not been the ticket, right? Clearly. And the way that a lot of advisors use our strategy to be very definitive about it is if you think about a 60-40 portfolio and you took 10 from the 60 and you took 10 from the 40 and you put it into one of our strategies, we think that you're going to dramatically improve your portfolio. You're going to add true asset diversification. You're going to reduce the correlation of the overall investable assets such that you have a lower correlation. It's much better risk managed. You step out of just owning stocks and bonds and you incorporate commodities and gold and real assets and other assets. And there's no reason not to do that because all of those things are available to you now. And as I said at the beginning, our company and our prior firm and 3Edge now, I mean, we sort of grew up with the ETF industry. And as the industry expanded, it opened up to us more investment opportunities. And think about gold. We were actually right there with State Street and the World Gold Council when they first launched, I can't say the ticker, but they first launched their gold ETF. And before that, we had to buy gold mining companies if we wanted, exposure, because we weren't going to buy physical gold. We had separately managed accounts. It's a long story. But back to the 60-40 portfolio. It's going to really struggle here. And as Michael said, there have been so many years where interest rates have declined. The Fed has been so easy in terms of their accommodation. It's an easy strategy to pursue in the environment we've been in. We don't think we're in that environment going forward from here. And so you're going to have to do different things. And a 60-40 portfolio, the 40 is not going to provide you the downside protection that it did. And, let's face it, we might have pulled forward a lot of equity market returns here by, in the bull market that we just experienced. So our feeling is that equities could disappoint, bonds could disappoint. So you need to think outside just being in stocks, just being in bonds. And it's not only for risk management purposes, it can be additive to returns because you're going to hold asset classes that could go up when traditional stocks or bonds struggle. So we very much feel like there's no need to just pursue that 60-40 with all the vehicles available and the wealth of knowledge at places like State Street Global. Advisors need to just expand their horizons a bit and consider a bit more of a robust portfolio allocation across asset classes and across geographies. So that would be how I would define our take on that.
Yeah, so it's interesting. I wrote an article in March around this idea that investors may have missed kind of the first shift we've seen in the investing landscape in 40 years. And so if you think about, and Fritz is kind of talking a little bit about this, if interest rates peaked back in the early 1980s, essentially for my entire investment career,
right,
rates have been falling. Again, there's been some periods of rising, but generally the direction has been trending lower. Inflation has been mostly benign. So in fact, for the decade prior to the pandemic, inflation in the United States averaged less than 2% a year. In fact, for much of the 2000s, the early 2000s, the big concern of the Fed was deflation, not inflation. And so that's really been something that's kind of occurred. We've had this peacetime dividend between the world's military superpowers, and we've had globalization trends, which have helped to keep those rates and inflation down. And so again, I think Dan mentioned it, Fritz mentioned it, and I'll kind of emphasize it here. My view is over the last few years, there's been a number of things that have been the catalyst to perhaps change that environment. The US-China trade war, the pandemic and its aftershocks, things like China's zero COVID strategy, the Ukraine-Russia conflict, for example, and now what could be the end of the quantitative easing era globally. And again, I think what's interesting here is this is not a US phenomenon. Inflation is rampant globally, rates are rising globally, and central banks are tightening globally. So even the ECB, the purveyor of negative interest rates that no one ever even saw, is going to raise interest rates. And so now this environment's categorized by rising rates, elevated inflation, some challenges on the military front, and deglobalization trends. And so my view is that 60-40 that may have worked so well, long duration growth assets, just buying bonds, is likely not going to be the portfolio you need for the next 5 to 10 years, or maybe even longer. And so kind of we've seen this, and we have a great chart in that piece that Fritz and Dan have been so kind to continue to praise and share, that what's really fascinating is not only is the 60-40 portfolio had a drawdown, the more conservative you've gotten by adding bonds, it's been worse because of the interest rate rise. It's actually done on par equal. So you got to think differently. And our view is, again, that there are some opportunities here when it comes to portfolio construction to take advantage of some inflationary beneficiaries, some dividend paying stocks, those types of things that we think will do better, will do reasonably well under that changed environment.
Yeah, and I think one of the challenges is that many investment professionals haven't had to face this, these challenges that we could be experiencing going forward from here, because it has been such an extended period. So I think that's going to be, that's potentially part of the challenge.
And I think Dan and Fritz would agree. So I don't want it to come across as doom and gloom. It's not. It's the environment has changed in such a way that what worked for the last 40 years may not work for the next 40. So what I'm talking about, and I think Dan and Fritz are probably kind of aligned with this, I'm not saying run for the hills, go to cash, the investments aren't going to work. What we're talking about is simply at the margin, recalibrating portfolios to take advantage of today's investment environment, today's investment opportunities. And I'm not so sure that portfolios have shifted as dramatically. So again, for us, it's things like high quality companies, value, inflation beneficiaries. We think that these are the types of things that will be leadership now versus kind of the FANG type stocks, long duration growth stocks, unprofitable growth stocks, kind of more traditional bonds, that type of thing. So it's what we're talking about is incrementally at the margins, beginning to recalibrate portfolios to a better align with today's environment, which we think might be shifting, might be changing.
So before we go further on, I want to define quality and define what value is, because I often find that there are different definitions by different people on those two factors.
Right. I think both quality and value are in the eye of the beholder. So the way I think about quality is companies with healthy balance sheets, low earnings variability, or said more plainly, stable earnings, that are paying or growing dividends, have low debt to equity, and have copious amounts of cash flow. To me, these are attributes that represent quality. And so, for example, we like the S&P Dividend Aristocrats Index. So this is companies that have grown their dividends for 20 consecutive years. Okay. So what type of company can do that? Well, one that exhibits the attributes that I talked about. On the value side, again, I've had a lot of questions of late. Is Meta a value company? It compounds cash flow at 15%, now trades at 20 times forward earnings, got a pretty good moat around it in terms of business, in terms of oligopoly, or I wouldn't say monopoly, but certainly some really ingrained comparative advantages. And I would say, that seems like a reasonably good business at those valuations. And again, I'm not here peddling meta stock. I'm giving an example that, companies that are compounding cash flow at a high rate, that are trading at, market multiples, that to me is value. Whether they end up in the index or not, who knows? But we think that valued companies right now have earnings growth that's higher than traditional growth companies, traded at a lower valuation. And if we look at the monthly excess returns when rates are rising, growth underperforms and value outperforms. So we want more value in our portfolio than we do growth at this point.
Yeah, I mean, we would certainly agree with that. I mean, we have felt that the S&P, just for example, has been significantly overvalued for an extended period of time. And we would also say that even now, after this correction, we think that the S&P is still significantly overvalued. And, it doesn't really even matter how you discount those future cash flows. If any way you slice it, to us, the S&P is still fairly dramatically overvalued. So whenever we have been above our minimum in equities, that has shifted towards value. It's kind of funny now too, because I feel like people were afraid to say value because they suffered for so long. So then they called them dividend growers and but those are definitely the types of equities that we are much more attracted to, and think that is the place to be. And it's been a long time for them. So let them have their share for now. I think that is how things will play out in the foreseeable future in the environment that we're shifting into.
So when advisors have been doing plans, right, for their clients, they've been making certain assumptions around inflation. Now those assumptions may be changing. I know that you're not planners, but what types of assumptions should people be looking to in the way of inflation when they're working through their plans at this point? Because people are really jammed up if inflation is going to be a problem for the next couple of years.
So I think that the Fed will raise rates to combat inflation, and you will begin to see inflation data moderate. And that's why I think when we started this conversation a little more than 45 minutes ago, we're talking about the Fed. That's why I'm really curious about today's summary of economic projections. What is the Fed going to say about inflation? Because boy, they're anticipating it will kind of get down to a level less than 3% in the next kind of year or two. And I'm not so sure. So I still think that structurally, there are a number of things that are likely to keep inflation elevated. So we thought, for example, that inflation would moderate some when supply chains cleared. And I think Fritz did a great job of talking about China's zero COVID strategy, and the Russia-Ukraine conflict is likely to keep that inflation higher. The other component of inflation, as we know, is wages. And there's 11.5 million job openings and only 6 million people to fill that job. And so as a result, we expect wage inflation, which is kind of stickier, to stick around. And then finally, rents are increasing. So we know, even though housing's beginning to roll over some because of higher rates, just a week or so ago, the Case-Shiller year-over-year number across the country was at 21% in terms of housing price increases. There's about a 12-month lagged effect on rents. Anecdotally, I've been sharing this. My dad, he lives in St. Augustine, Florida. He's a little more than 80. His rent just went up 22% this year, and others are experiencing that. So our view is given those important components of inflation, for planning purposes, we're not expecting it to go back down to 2.5%. We think kind of in that, maybe that 3.5, 3 to 4%-ish range from a longer term perspective is probably more appropriate for your planning purposes. And more in the short term, probably higher, right? So for the next year, inflation expectations are for 6% or more. I think longer term, it's likely to gravitate towards 4%. But let's just keep in mind, that's double the pre-pandemic levels that we observed.
Right. So, and in terms of, we do serve the advisor market. And one of the things we talk about and try to explain what we're going through is we just talk about the seasons of the market, right? So you have the spring, you have easy monetary policy, your stocks are doing well, the economy is recovering, then the economy might start to overheat, the market might start to overheat, you have inflationary pressure, and your equities maybe stop outperforming, then your real assets take over. And then you could have the Fed reacting to that, which we have now, and they could overreact, let's say, and you push you into credit contraction. And at that point, you probably don't want to hold stock, bonds, or real assets. You want to hold more cash. So if you're an advisor and you're thinking about your client who has these, financial goals, which are investment goals, which are actually, actually their life goals, we would say expand the universe of investments that you would consider putting into a client's portfolio to give them the best chance of getting through what was a low inflation environment and now facing a higher inflation environment. And one thing that's very important about that diversification for your client is it enables the client to stay invested, because that is the hardest thing for advisors. I hear so often clients, and it's no fault of their own, it's hard, but you tend to do the wrong thing at exactly the wrong time. So if you at least have enough diversification that you can ride through periods like we're experiencing now, your client has the best chance of achieving the investment and the financial goals that you have laid out for them. But you certainly have to adjust your inflation expectation numbers going forward from here. Absolutely.
So, I have to push back a little bit, because when correlation goes to 1 across every asset class, mostly right now, diversification doesn't really help. Maybe with the rebound, it will help, and that's what you're communicating.
Well, so we were overweight gold and commodities for an extended period through last year and through this year. Now, gold has given back much, if not all, of those gains. Commodities have not. They're probably still up 30%. So that diversification has helped. But what I would say is that there's a real possibility that we could have a period where you're going to have to carry a larger cash balance in order to protect yourself from this potential for a credit contraction, which is not from the inflation itself, it's from the Fed's reaction to the inflation. So that, I would say, you're absolutely right. That is when your correlations go to 1. And the only thing that's going to help you at that point is the willingness to carry a much larger cash balance at that time. So I agree.
So Michael, also I want to push back on something, because I struggle with this allocation. REITs, right? I think we talked about this, right? I've been living in the same apartment. It's not rent stabilized for about 50 years. That makes me old and comfortable too. But I might actually see a meaningful increase in my rent. God, I just hope it's not 20%. It's counterintuitive to me that rent can go up that dramatically when circumstances and conditions are so out of whack, right? I would think that real estate would be going down because it's actually so inflated.
Right. You may start to see some of this. Again, it's a little backward looking from that standpoint. Now, that said, as you talk about real estate REITs, those types of things, I think what's interesting here is that real estate, from an investment perspective, tends to have low labor intensity, so is not as negatively impacted by rising wages. And ultimately, real estate tends to benefit from an inflationary environment, as those prices go up, just generally speaking, from that standpoint. Now, the other thing that I think is interesting here, and again, there's some of this that's a little bit makes me even a little skeptical on the this time is different front. However, what I will leave with you is that housing shortages are estimated around 3 million fewer homes that we need that are not available. So capacity needs is low. Supply is quite low across kind of real estate, particularly in residential, for example, which is driving up prices. The other thing I'll leave you with is the millennials, who are now just as big as the boomers. So I think it's easy for someone like me, who's like to suggest that, oh, the millennials are these young people. Well, the oldest of the millennials is now 40. The median of the millennials is 30. The biggest area of consumption for home buying, the median age is 33. So the biggest part of the millennial generation is entering prime home buying age at a time when supply is incredibly constrained. And so I do think that it's kind of interesting, but admittedly, higher rates, kind of some of these things are likely to dampen some demand for real estate. People will put off purchases, that type of thing. But at least here, there are some structural things that I think are likely to keep real estate prices elevated for a while longer, perhaps kind of counterintuitively.
Interesting.
And you're coming from the perspective, of living in Boston. Is that?
Yes, I'm in the Boston area. Yeah.
And Fritz, you're in Virginia. Do I have that right?
No. I'm outside of Boston, Concord, Massachusetts.
Yeah.
Okay.
Where houses. It's interesting, though. I will tell you that there were no supply whatsoever up until the last month and a half, and now you're starting to see supply come on, more and more houses for sale in the area. And I wonder if people that say, "Oh, gee, better get out now," while we are where we are. So interesting. But,
yeah, I was going to say, I think that's it, right? That try to strike while the iron is hot and before demand begins to fall over due to higher, rates. And again, it's well publicized now that that 30-year fixed rate mortgage rates were, I think, 5.5% a week or so ago. They're now 6.3%. So
amazing.
The rate of which they're increasing is just amazing. So Dan, to your point, that's going to dampen some, housing demand for sure. But
the other quick thing about REITs that the problem though could be that they have a lot of leverage though, right?
Yeah, potentially. And I think the other thing that as yields climb, those that have used REITs in particular as a bond proxy will exit for something else. So that could put some additional downward pressure. But again, generally speaking, they tend to benefit from inflationary environment. I do, as we're kind of circling around this, the risk to many of these items that we're suggesting, commodities, real estate, et cetera, is a rapid decline in demand, a full-blown kind of recession that lasts a while.
Yeah.
And again, Fritz, to your point there, the investment options that will perform well are usually limited. You want to kind of hold on to some cash to put to work at better prices.
Yep.
And that type of thing. And then Dan, to kind of your comment, typically once we do begin to exit out of that recession and we rally, historically as categories, small cap and value lead coming out of that in terms of coming out of recession. They tend to be the ones that kind of rally most quickly, most aggressively out of those recessions.
So we're now at the top of the hour. I have to say, I was really pleased. This was uplifting, right? We have strategies and solutions for folks. Too many of these calls that I'm on, frankly, depress the crap out of me. Oops, that was too strong. Anyway, so thanks so much for your time. Now, Fritz, this is always a moment where the person in your role gets to highlight a charity.
Yeah.
Please highlight the charity that's in the chat as well, and why you chose that one.
Yeah. So the charity that we're a small firm, right? We're a boutique investment management firm. And so we can't be involved in all these different nonprofits, but one area that we are involved with is an organization called Year Up. And Year Up was started by a fellow, actually up here, Jerry Chertavian, in 2000. And the idea is to help, in our case, we were able to hire a student intern who maybe came from a more disadvantaged situation. And they give these students training and an education, and they're just very, very supportive. So we actually hired an intern from Year Up, and now we've made an offer to that fellow, and he's going to join our firm on a full-time basis. So it's a great charity reaching into communities that may be struggling, and through education and training and job opportunities, trying to close that opportunity gap, if you will, which is really necessary because there aren't enough people to fill, all the jobs that are out there now. So Year Up is really a great organization. And even as a very small firm, we've been able to participate. It's worked really great for us. So I'm happy to support them and shout out to them.
Wonderful. Thanks very much, both of you. Look forward to 2:00.
Yeah.
We'll see if it's 75 basis points, and be healthy. I think that's the most important thing right now.
And if it's not 75, we go back and re-record maybe.
Okay. Have a good one.
Thank you very much. Appreciate it.
Bye-bye. Thanks,
now.
Michael.
Yeah, absolutely.
Thank you.
The views and opinions expressed during this event are those of the participants and do not necessarily reflect the views of the sponsor or organizer. Information set forth during this event has been obtained or derived from sources believed by the participants to be reliable. However, neither the sponsor nor the organizer make any representation or warranty, express or implied, as to the information's accuracy or completeness, nor does the sponsor or organizer recommend that the information shared during this event serve as the basis of any investment decision, and it has been provided to you solely for informational purposes only, and does not constitute an offer or solicitation of an offer or any advice or recommendation to purchase any securities or other financial instruments, and may not be construed as such. Past performance does not guarantee future results. This interview is being distributed for informational purposes only and should not be considered as investment advice or recommendation of any particular security, strategy, or investment product. It does not constitute legal or tax advice. The information provided is not intended as a complete analysis of every material fact, and the underlying assumptions and views are subject to change based on market and other conditions. All investments involve risks, including possible loss of principal.